Welcome to This Explainer. Today, we're unpacking a story that plays out less like your standard business transaction and honestly a lot more like a high-stakes corporate thriller. We are going to examine one of the most infamous, monumental M&A failures in the entire history of the tech industry. Because this isn't just a story about a company buying another company. It's a total cinematic tale of blinding ambition, ignored warnings, and a catastrophic clash of corporate identities. We're going to break down exactly how a massive strategic pivot went horribly, horribly wrong, using the data and the intricate details to understand the anatomy of a multi-billion-dollar disaster. Okay, let's dive right into this. $8.8 billion. Just let the sheer scale of that number sink in for a second. That is not how much money was spent. That is how much money simply evaporated. It's the staggering write-down from an $11 billion acquisition. Imagine buying an asset, bringing it into your portfolio, and realizing almost immediately that nearly 80% of what you just paid for doesn't actually exist. That is exactly what happened to Hewlett-Packard. Now, to understand how a tech titan could make such a colossal miscalculation, we really have to go back to the very beginning of this deal and look at the underlying motives.
So, Chapter 1, the software pivot, a desperate transformation.
To set the scene, at the time, HP was famously a hardware company, right? They built the computers, the servers, the printers. But the hardware business was becoming incredibly tough. The PC markets were commoditizing, margins were shrinking drastically, and these agile software giants were essentially eating the industry's lunch. HP's CEO at the time, Leo Apotheker, was under immense, crushing pressure from the board to fix the stock price and reinvent this legacy brand, practically overnight. So he had this grand, sweeping vision. He wanted HP to shed its hardware skin entirely and pivot to become a high-margin software giant, kind of like what IBM had successfully done years earlier. And you have to understand, this wasn't just a casual strategic shift. It was a fundamental, desperate need to transform the company's DNA. That intense desire to change created a profound psychological desperation at the highest levels of leadership. They needed a massive software acquisition to prove to the market and honestly to themselves that they were evolving. And that sheer desperation became the distorted lens through which they viewed absolutely everything that followed.
Which brings us to our next phase, ignoring the red flags, blinding ambition.
Listen, when you're spending $11 billion, you do your homework. That's due diligence. But in this case, the due diligence process was flashing bright red. First off, HP's own internal financial teams raised serious, documented concerns about the valuation. They were looking at Autonomy, this British enterprise software company, and saying, hey, the math isn't adding up. The premium they were paying was dangerously high. Second, and even more critically, there were deep, fundamental doubts regarding Autonomy's accounting practices. There were whispers and distinct red flags about how revenue was actually being recognized. Auditors were noticing these massive licensing deals that seemed, well, prematurely booked, and hardware sales that were somehow being disguised to look like high-margin software revenue. Yet, instead of pumping the brakes to investigate these massive financial discrepancies, leadership pushed incredibly hard to just rush and close the deal. The ambition to transform completely overshadowed basic financial reality. Which really forces us to pause and ask this critical question. Why did HP ignore their own alarms? If the smartest financial minds inside your own building are telling you to stop, why do you hit the gas? Well, the answer lies in the sheer psychological momentum of the deal, and of course the classic trap of the sunk cost fallacy. Once a massive corporation commits to a narrative, in this case the narrative that they absolutely must become a software giant right now, hubris takes over. The leadership became so blinded by the shiny future they envisioned that acknowledging the red flags in the present felt like an unacceptable personal and professional failure. They didn't want to hear the truth, because the truth would have killed the exact transformation they were desperate for.
Let's move to and see how this builds into our next chapter. Hitting the integration wall, cultures collide.
Okay, so the deal closes, the ink is dry, and now the real work begins, right? Bringing these two companies together. But look at what we're working with. On one side, you have HP. This is an established, massive, traditional hardware bureaucracy. Hundreds of thousands of employees. It's methodical, heavily structured, heavily lawyered, and moves at the deliberate pace of global supply chain manufacturing. On the flip side, you have Autonomy, a dynamic, fast-moving, aggressive, and highly sales-driven software culture. They operated with intense agility and, as it turned out, incredible opacity. These are two completely, fundamentally opposed corporate environments. You cannot just smash a freewheeling software startup culture into a legacy hardware giant and expect them to interlock perfectly. The technology integration, literally the very synergy that HP paid billions of dollars to achieve, violently stalled out. It was a complete failure of people, processes, and philosophies to speak the same language.
And what happens when you have that extreme level of cultural friction? The talent leaves. Rapid leadership turnover brought the entire technology merger to a grinding halt. The culture clash was toxic almost immediately. Autonomy's founder and key executives relentlessly clashed with HP's bureaucratic oversight. Within a year, Autonomy's CEO was forced out. Following him, the brilliant engineers and minds at Autonomy, the very people who actually understood the immensely complex software HP had just purchased, began heading for the exits. When the human capital drains out of a software company, the value goes right along with it. The very integration that was supposed to save HP was suddenly paralyzed from the inside out.
Now we reach the climax, the massive financial write-down. The illusion shatters. And this brilliantly illustrates the fallout. The devastation here is staggering. Out of a massive $11 billion purchase price, a dark, overwhelming 80% of it, $8.8 billion, had to be completely written down. Poof, erased from the balance sheet overnight. All that remained of this grand strategic pivot was a meager $2.2 billion in remaining value. It stands as one of the most stunning, rapid destructions of corporate wealth in modern business history. Those red flags that leadership chose to ignore during due diligence, they didn't magically disappear. They just compounded in the shadows and ultimately caught up to the balance sheet in a catastrophic way. So, how exactly did HP justify this historic, humiliating write-down to their shareholders? They pointed to accounting improprieties. These were core allegations of severe, intentional financial misrepresentation by Autonomy prior to the sale. HP basically claimed they were the victims of an elaborate deception. Honestly, the allegations were pure corporate true crime. Autonomy was accused of orchestrating these round-trip deals where they allegedly sold hardware at a steep loss to resellers who would then buy Autonomy software to make up the difference. Autonomy would then book the entire transaction as pure high-margin software revenue, artificially pumping up their growth metrics and making the company look vastly more profitable than it actually was. This explosive revelation was the pin that finally burst that $11 billion bubble. And, when billions vanish, the lawyers step in. This triggered years of bitter, complex legal warfare between HP and Autonomy's former leadership. Walking through this timeline reveals the truly shocking, rapid speed of this disaster. Let's look at it. Month 1. The ambitious acquisition is announced with massive fanfare. The future is software. But fast forward just to month 11. The culture clash has taken its terminal toll, and rapid leadership turnover is completely gutting the acquired company. Then, month 14. Barely over a year after the initial triumph, the $8.8 billion scandal is shockingly revealed to the world. And for years later, long after the executives who originally brokered the deal have been fired or moved on, the companies are locked in endless, draining legal battles. It just emphasizes how incredibly fast a celebrated $11 billion pivot can spiral into a historic disaster when it's built on a fragile, unverified foundation. So the crucial point is right here: the cost of rushing. A cautionary tale. In the race to reinvent a company, what is the true cost of blinding yourself to the red flags? I really want you to take that question away and reflect on it. Strategy is deeply important, for sure. Vision is absolutely necessary. But when the desperate need to transform your corporate identity causes you to actively ignore fundamental financial realities, the results are completely catastrophic. It's a powerful and incredibly expensive reminder that in business, trying to buy an instant new identity often comes at a price you simply cannot afford. Thank you so much for joining me for this explainer, and remember to always keep questioning the data behind